What's going on, everybody? Good morning and welcome back to Beat the Bell, presented by King Capital. Hope you guys had an awesome weekend. New trading week about to get underway. Hope you guys are ready and fired up. Let's introduce today's panel, starting with Money Mander. Money Mander, good morning.
Good morning. Happy Monday. New week after Wild West trading last week, and we'll show you guys what we're preparing for this week.
All right, Diamond Trades, good morning.
Good morning to you all. Wearing sunglasses today for two reasons. One, in solidarity with my boy Prime Time, who got absolutely clapped by Oregon on Saturday, and then also in solidarity with my boy Snipes, who just had the worst possible weekend and came out with a black eye. So just standing with both of those two great men today.
All right, Stock Snipa.
So that's not exactly how it went. It has been a long weekend, but that's
just roll with it, brother. It's a better story than the truth, so just roll with it. All right, Fed forecast and economic calendar.
Yeah, let's go ahead and dive into it. I'm going to take these off now because I do look a little bit ridiculous. But let's go ahead and get into it. Let's start with the economic calendar for this week. So we do have a very, very busy week as far as high impact news. Two manufacturing index readings today. Tomorrow we've got Case-Shiller home prices as well as new home sales and a Fed speaker Wednesday. Durable goods orders before market open. Thursday will probably be the biggest day of the week with GDP growth quarter over quarter. That's the initial reading. And then we've got a couple of Fed speakers as well as pending home sales and the weekly unemployment claims. And then Friday, we've got core PCE as well as Chicago PMI and UMich consumer sentiment. So definitely a stacked week as far as the economic calendar goes. Let's go ahead and take a look at earnings for this week. Earnings calendar is a little bit lighter. Some names to watch for sure will be Costco reporting on Tuesday after the close. Micron reporting on Wednesday after the close. Micron is in the semiconductor industry, one of the leading industries as far as the market goes. So I want to pay attention to that. And then Nike as well on Thursday after the close. So let's dive into a little bit of last week's trading. As Sal mentioned earlier, was extremely volatile. The news drivers produced a lot of volatility as markets put in their worst week since March. The S&P 500 fell 2.9%. The NASDAQ fell 3.9%, and the Dow lost 1.9% as investors grappled with the latest signs from the Fed that interest rates are to remain elevated for much longer than initially anticipated. Most of the damage this week, or last week rather, was done by the big tech stocks that helped to push the NASDAQ close to all-time highs in the last several months. NVIDIA and Google both closed the week down 5% or more, and Amazon fell 8% as well. Last week's drop has many comparing the recent price action to how the market was trading ahead of the crash of 1987. As we all know, times are different, and the past doesn't necessarily always predict the future, but the comparison is an interesting one given the headwinds for the United States economy that we have coming around the horizon here. So let's talk about that. While economies abroad have been struggling, the U.S. economy has remained more resilient than many have anticipated. So resilient, in fact, that some are now saying that a soft landing where the Fed can cool off the economy and to stave off inflation without pulling the country into a recession is the most likely outcome. But just when you thought we had some smooth sailing ahead, the United States economy faces four unique issues that, when combined, could be enough to cause considerable or non-negligible economic damage. The first of which being the United Auto Workers strike. So far, 13,000 workers have begun to strike at three American automotive plants, a strike that is believed could expand to 38 plants across 20 states before it's all said and done. According to Goldman Sachs, a broad strike would shave off between 0.5 and 0.1 percentage point of annualized economic growth for every week that it lasts. The second headwind being a potential government shutdown that is looming on the horizon. The last time that the government shut down in a similar situation was in 2018. That shutdown lasted for 5 weeks and left about 300,000 workers furloughed, costing 0.1% of Q4 GDP that year. It's estimated that this government shutdown would actually be worse, with potentially 800,000 workers at risk of being furloughed if lawmakers cannot reach an agreement. The third headwind that the United States economy is facing is the resumption of federal student loan payments on October 1st. The average bill is going to be between $200 and $300 per person per month. and that's expected to divert around $100 billion from consumers' pockets over the next full year. And then finally, oil prices. We talked about oil prices last week. Oil prices are sitting above $90 a barrel versus the $70 that we had a little bit earlier. The summer increased energy prices obviously affect both businesses as it increases their spending, and it hurts consumers as they have less disposable income to spend. So each of these individually likely wouldn't be enough to really cause a ton of damage to the economy. But I think the combination of all of them as we sort of head into the end of Q3 here is what has economists and speculators a little bit worried as we head into October here. Mander, what do you think?
Yeah, I think it's interesting because individually on each of them, it's nothing we haven't talked about really for the past month. Everyone knew all of these catalysts individually were coming up. Maybe if you take out the auto workers strike that's happening. But I think the Fed induced finally the volume and the volatility that you needed to see for all of these catalysts to kind of take place and give a reaction in the marketplace. And going back to last week, in the S&P 500, it was the highest volume week we've seen since June 12th, I believe, pretty much all summer into now in the start of the fall here, the highest volume week we've seen. And it was actually the largest outflow week we've seen from U.S. equities since December of 2022. So if that puts anything into context here, obviously we have all these tailwinds and headwinds coming into pretty much where we're trading at right now, almost at all-time highs in tech. We're up to 460, 4,600 in the S&P 500. All of these kind of showed their true colors last week, but I think a lot of this was built up through most of really the whole summer rally and is now just finally getting this turn in volatility. But if we look into cumulative short flow across the U.S. equities, also into new year-to-date highs. So pretty much what you're getting is all of these combined pretty much just put a further down tail to the markets than we even saw with the bank crisis going back into March. So that's it's interesting where we're trading it. Obviously, I think the Fed put the icing on the cake there with the higher for longer mantra. They raised their projections into next year by 50 basis points and into 2025, which we talked about on Friday, and that sent rates through the roof. But I think now you're kind of starting to see the full picture of all of these tailwinds and headwinds that we kind of had building up for the past several months, even through the summer rally, now finally all kind of coming out here as investors kind of weigh the realistic risk that we're starting to see on where we're trading at.
About a replay of 1987. Are you concerned about some 1987 price action? I've seen that comparison just literally floating around on social media the entire weekend. And while I obviously don't think that, I think, what was it in 1987? We saw 22%, I believe, in a day.
Black Monday
absurd, something absurd like that. While I'm not necessarily expecting that, I do think that it's it's worth the watch, right? I think that it's particularly it's the same time of year as well. We're coming into that October time where the market likes to get a little wobbly. So I don't know. I'm definitely interested to see how we trade over the next couple of months, particularly as, like you said, we head into some key support levels in both the S&P 500 and the NASDAQ. But yeah, that'll wrap it up for us here at Fed Forecast. Pass it back to Alejandro.
All right. Thanks, guys. Let's take a look at the S&P. All right. So clearly a change of pace in September, as the guys are talking about. Seasonally, this is the weakest time of the year, September into early October. And then we typically see a rally in the second half of October through the end of the year. So brighter days are likely ahead for bulls, but for now, things have been tough for bulls. As we can see on the system, we did get the sell signal, the 30-minute 10 SMA crossing below the 50 SMA, serving as resistance. Same thing on the hourly chart. We got the sell signal, 50 SMA, serving as resistance. So no secret there as to why we have been selling. Of course, the actionable trade signal would be the cross or shorting at the 50 SMA. Other than that, it's important to find your own setups, trading support and resistance along the way. But in general, this is a great indication of momentum for the entirety, nearly the entirety of the summer. We saw that we were trading above the 50 SMA, right, on both the 30-minute and 1 hour charts. But that narrative has completely changed, and there has clearly been a shift in regime. So tracking really nicely with seasonality. As I mentioned, we typically get this sell-off and then have a strong end to the year, but we want to proceed with caution still over the next few weeks until that later half of October, where things will likely start to turn and then November and December are two of the most bullish months of the year. So bulls will have that to look forward to. Also important to watch this 50 SMA. It is starting to come down. Again, visual representation of momentum in the market. The bears are clearly in control here. Once we can climb back above that 50 SMA, that'll also be a really nice signal that bulls are ready to send things higher once again. All right, so that is what to look for in regards to the system. Let's go over to Snipes now for Bet the Bell.
What's up, guys? Welcome back to Bet the Bell. I know you guys missed me. Wasn't here last week. I'm coming live from Croatia right now, but I got some sick questions. Let's get to it. The first question, as typical, you know exactly what I'm going to ask, but it's green or red. I'm going to have to start this one off with Alejandro.
I'm going red today.
Okay.
Looks ugly, man. Looks ugly out there.
Diamond, what you got?
I'm gonna go red as well. It's sloppy trading in the pre-market. It doesn't look good.
Money Mander.
Yeah, I hate to do this. I'm also going to take red, especially because we got this rally at the start of the Sunday session yesterday, just getting absolutely sold this morning. I'm going to take red.
Yeah, I mean, at this point, I'm going to have to go with red as well. It's kind of red across the board. Considering what we're seeing in the pre-market, I feel like it's pretty
I will say we on Friday we all went green because we were up in the pre-market and they sold it off in the day in close.
Wow.
I think we all took the L on Friday.
Wow. So I'm going to jump over towards my next question here. I got a pretty interesting one here. It's one of those would you rather. Now, keep in mind that you have to own this stock for 1 year. You cannot sell it under any circumstances or any exceptions. But would you rather own $500,000 worth of ExxonMobil, or would you rather own $375,000 worth of Tesla? I'm going to go ahead and start this one off with Money Mander.
So I'm going to take the Tesla on this one, namely because where oil is trading at right now, coming up on this $100 a barrel level here, I think XOM has probably seen the better part of upside here where it's trading at. Whereas Tesla, I think could easily still have another 100%, 75% upside into a year from now. So I'm going to take the Tesla on this one.
Alejandro, what you got for me?
I'm definitely going Tesla. As you guys know, I'm a big Tesla fan. Not so much of an XOM fan because I don't know much about the stock, so I'm just going to pick the one that that I know more about and that I'm already invested in, so that's going to be Tesla.
Diamond Trades.
I'm going to take Tesla as well, but I definitely am going to take it because I agree with Mander's sentiments, right? You look at how oil has been trading, you look at XOM, it's more or less at year-to-date highs. Year-to-date highs are what, 118, stocks at 115 right now. So I agree. I think that while XOM, long-term, obviously like not like a bad stock, I would rather have Tesla in this situation, just with given sort of where XOM is trading and what oil has done over the past several months and the outlook into next year for oil and the economy in general. So take Tesla.
There is an honorable mention to that extra $125,000 on Exxon. In my opinion, it's very close, but I'm going to have to take the 375 with Tesla just because of that potential. But again, Tesla is much more volatile. We could see it being just as rough. Next, I'm going to ask my next and final question. And this is a pretty interesting one. This is a hot take. I've been seeing it all over social media. But do you think that UPS drivers are being overpaid or Amazon workers being underpaid? Now, keep in mind that the UPS drivers are making $170,000 on a 5-year contract. So after the 5 years kicks in, that's when they start to see $170,000 a year. So they are rewarding relative seniority there. They want people with some nice human capital to be making these salaries. But I'm going to go ahead and start this one off with Money Mander. Are UPS drivers overpaid or Amazon workers underpaid?
This is a tough one for me to answer, right? Because I've never been involved in the logistics avenue. I've never seen what profits drivers pull out of that $170,000 for the company. But just off my base gut here, I'll just say I think Amazon's probably being underpaid here. And I know Amazon is really trying to go towards an automated logistical approach over the next decade or so. So they're probably not too keen to pay them any more in the near term. So we'll see how that works out if they start losing workers.
Does this mean it's my turn to answer the question?
Yeah, while you're having like a little sad man moment over there.
No, I was just waiting for you to call my name. I guess you forgot how to host. All
I
right.
actually did it, and I realized I was on mute.
All right. UPS overpaid, Amazon underpaid. I'm definitely going to lean towards Amazon being underpaid here. I actually don't know exactly how much they make, but I imagine it's not a lot, especially for Amazon. What UPS is doing here, I think, is pretty awesome. The reason I say that is because our generation, specifically, the theme and what has become normal is you go to high school, you go from high school to a college. Most people incur large amounts of debt to get a college education, come out of school and make about $45,000. Working wherever, with six figures of college debt, and it's just become what's normal, right? Everybody's expected to become or to graduate with a college degree and work a corporate job, whereas the skilled labor workers, and I'm not sure that UPS directly falls in that category, but skilled labor workers, the demand is high now because there aren't as many people who are actually working those jobs, and the people working in unions, the plumbers, electricians, those guys make a ton of money, but nobody really does that anymore. Nobody, the what everybody wants to do now is get that college degree. And so what UPS is doing here, I think, is really interesting. Delivery workers making money, making a lot more money than people with college degrees who are working in corporate jobs, to me, is really interesting. I think it makes a strong point that we need, more blue collar workers. And so, yeah, I definitely support what UPS is doing here.
I like that answer. I'm going to have to agree there. It's pretty obvious that UPS's business model targets people that have high human capital, that know what they're doing. So basically, they're not going to pay you until those 5 years come by. Now, in those 5 years, you're going to learn a thing or two. You're definitely going to be proficient, if not really good at your job. So that's exactly what UPS is looking there. And versus Amazon and their model, I feel like they could care less, if they have another driver in a week. But yeah, I mean, overall, we could definitely see that UPS wants these skilled workers. So I do like that, because they're pretty much saying, work for us for 5 years, get good at this, understand how to do it and the ins and outs of it, and you're going to get a nice salary. But that's all I got regarding this. I almost skipped Diamond here. Diamond,
No, I was just gonna agree with I like Hondo's point. First of all, I agree with a lot of things that he said. Secondly, when you look at the actual, first, we had a comment as well. The 170K isn't necessarily their entire salary. It's like you add the benefits in there as well. So looking at the actual salaries, like right now in New Jersey where I live, the average salary for a Amazon driver is somewhere in the range of like $18-19 an hour, and then for UPS it's somewhere in, I believe, the $28 range, with like the upper quartile making $40 an hour. So it's not, I think, as wide of a disparity as it may seem, especially like with the initial soundbite on social media. It kind of made things look like there was a much like wider disparity. But I do 100% agree with what Alejandro was saying, in the sense that making these more blue collar jobs look more attractive for folks who, whether they're still in school, whether they haven't gone to school, or whether they're even out of school and maybe are looking to not necessarily get a job, in what they studied for, right? I mean, how many people are going to see this opportunity, and you might be making more doing this than than whatever it is that you went to school for. You might just say, this is my best opportunity right now, and I'm going to go and take it. I hope to see more companies sort of go this route, because I think that there are definitely people out there on the sidelines who are looking for these opportunities, and so yeah, I like it.
Yeah, that's all I got for today. That'll wrap it up for Bet the Bell. I'm passing it back to Hondo here.
All right, guys, 8:57 here. We're going to wrap up. Appreciate everybody that tuned in this morning. Have a great week, guys. We'll be trading live in the Kane Capital Discord. You can go to kane-capital.com to trade with us. Other than that, we'll see you guys back here on Wednesday morning at 8:30 a.m. Eastern Time. Take care, guys.